Hello and welcome to BYJU'S Exam Prep IAS. Welcome to the Target Prelims 2022 initiative of BYJU'S IAS. Today will be the third lecture on Indian economy. And as usual, if you have not yet subscribed to BYJU'S Exam Prep IAS, please do that right now. Hit the bell icon so that whenever the classes will go live, you will get a notification. And I hope all of you are fit and fine, and more importantly, preparing very vociferously for your UPSC exams. Now, let's start the discussion for the day. The first question: consider the following statements regarding E-rupee. Now, this particular concept of E-rupee has been there in the discussion. As far as I am concerned, for UPSC prelims as well as mains, this is very important topic. First and foremost, what is this? The idea of E-rupee. E-rupee in simple terms is nothing but a digital voucher. Remember the terms here? E-rupee is nothing but a digital voucher. Government of India over a period of time has provided so many welfare measures, has spent so much of money. For example, in case of healthcare expenditure, in case of subsidies, Government of India annually incurs a huge amount of expenditure. But generally one concern that the government raises is whether these particular benefits are reaching the right beneficiary or not. And in order to address this particular issue of identifying and implementing these measures, government has already the concept of DBT, direct benefit transfer. And remember this, more than 300 schemes are already covered under the concept of direct benefit transfer. Now, one more very important initiative that has been launched by the government is this idea of a E-rupee. Right, I've already told you, E-rupee is nothing but the concept of a digital voucher. What is this idea of a digital voucher? Imagine you'll go to a shopping complex, you'll purchase a certain amount of goods, or let's say clothing as such. And this particular company or the one who is running this particular shopping complex will give you a voucher and say, sir, because you have purchased so much amount, or madam, because you have purchased so much amount, right, this voucher I will give it to you. Next time when you come back and purchase something from our shop, you can use the voucher to pay an amount of, let's say, 100 rupees. Right? I'm pretty sure all of you have received one or the other ways these kind of vouchers. Or when you make a payment, or let's say on Paytm, or let's say Google Pay, you will receive vouchers. So in the same way, Government of India now says, whenever I'm going to provide the benefits to the beneficiaries, I will use digital vouchers. I will be using digital vouchers. That is, let's say, hypothetically, Government of India wants me to get certain food grains, or let's say certain drugs. Again, when I say drugs, do not imagine something else. I'm not talking about Udta Punjab. I'm basically talking about medicines. Okay. So government wants me to purchase certain drugs. So government wants me to purchase it. So they are giving me assistance. Rather than giving money to me, now what the government will do is, they will ensure that I will get a voucher into my mobile phone. Either this particular voucher could be a QR code, or this particular voucher could be a string of messages consisting, let's say, the OTPs, or let's say certain password. What is the objective here? Government will identify the right beneficiary, transfer the benefit, transfer this QR code to this particular beneficiary. And because I am the beneficiary, I have received the QR code, I will show the QR code at, let's say, a certain pharmacy. They will scan it. I will give them the OTP, and now the money will be given to the pharmacy by the government, and the pharmacy will hand over the medicines, right, or the drugs to me. This is a basic concept of E-rupee. Although I've cut the process short, don't say, sir, you are telling the process wrong. There is a bank also involved. Yes, there is a bank involved. Generally, the process is like this. I'll come back to this. Here is the government, and here is the beneficiary. Government wants to provide the benefit to the beneficiary. So government will provide the mobile number as well as the identification of the beneficiary to a bank and transfer the money into the bank account. Now a QR code will be generated. Government will send the QR code to the beneficiary's mobile number. Now the beneficiary will go to, let's say, the pharmacy or the service provider, hospital, whatever it is. Provide the QR code, an OTP will be generated, it will be given to me. I will give the OTP to this particular pharmacy. Now the pharmacy will provide the services to me, and the money will be given to this particular service provider. This is generally how E-rupee system will work. Now, what are the statements? What are the important statement here? It is person and purpose specific. Statement 1 is correct. What do you mean by person and purpose specific? Government will ensure that these benefits, that is subsidy, will reach the right beneficiary. I am the beneficiary, the QR code or the SMS message will be sent to me. Now some of you will be scratching your head and say, sir, why are they sending QR code and the message also? If you have a smartphone, QR code, you can easily receive and show the QR code. What if you have a feature phone, Nokia 1100? In that particular situation, QR codes will not be eligible to be read in that particular phone. You will receive SMS messages or string of messages. So it is person and purpose specific. Purpose specific means if I receive a QR code, I can use the QR code for that purpose only. For example, here I discussed about the pharmacy or the medicine. The QR code that I have received, I can use it only to purchase medicines from the market. I cannot use that particular QR code, purchase anything else from the market. Person specific, purpose specific. Yes, statement 1 is correct. Can be used only by the government to provide benefits. Statement is wrong. Remember this. Government itself says either I can use this or even private sector can also utilize this. So second statement wrong. Third, will be delivered in the form of QR code or SMS strings, right? A string of messages. Third statement is correct. By the way, one more point is very important here. This system of E-rupee itself, right? Understand this, the name itself is indicative, has been developed by National Payments Corporation of India, NPCI. NPCI has developed this particular concept of E-rupee. And along with NPCI, there were other agencies also. For example, National Health Mission was a participant. Department of Financial Services, DFS, was a participant here. Ministry of Health and Family Welfare was also a participant. But most importantly, the organization which is involved in preparing this particular E-rupee is National Payments Corporation of India. That is also one more very important point. Remember this. Now here is just one correction. In the last class, I stated that RBI owns NPCI. Please make a correction here. RBI started NPCI, right? RBI started NPCI. RBI doesn't own NPCI. But anyways, come back to this particular question here. 1 and 3 are correct. So the right option for this particular question will be option C. Right option is option C. Let me go to the next. Right, certain points are there. Please go through this. Next question. The MCLR is a method of external benchmarking of lending rates. The external benchmarking is a recommendation of Rangarajan Committee. In external benchmarking, interest rates are hiked or linked to benchmark rates. Right? What is the meaning of this? In recent times, RBI has introduced the concept of external benchmarking. I will use a short form here, EB, external benchmarking. External benchmarking was the recommendation of Janak Raj Committee. Janak Raj Committee, and here itself, one of the points itself is wrong. So it was a recommendation of Janak Raj Committee. Done. Second, before we introduce the concept of external benchmarking, there was a benchmarking, or let's say the lending rate regime, by the name of MCLR, Marginal Cost of Funds Based Lending Rate. MCLR stands for Marginal Cost of Funds Based Lending Rate. Before MCLR, there was a base rate regime. There was the concept of base rate regime. Before base rate regime, there was a benchmark primary lending rate, BPLR, and before BPLR, there was a concept of PLR, right? Primary lending rate, benchmark primary lending rate, base rate regime, and MCLR. 93, 2003 or 4, 2010, 2016. In 2016, 1st April of 2016, MCLR was introduced. And very recently, the RBI has introduced one more concept of external benchmarking. Now understand the logic here. In case of external benchmarking, whatever is your lending rate, what do you mean by lending rate? A bank is there, bank will give loan to a customer, and when the bank will give the loan to a customer, the rate of interest will be charged. All of you will agree. For example, you are a bank, I will take a loan from you. Will you give it free of a cost? Of course no. You will say, sir, yes, I know you are a teacher, right? I know you teach economics also, and you have irritated me a lot during my study days. But now the ball is in my court. I will give you a loan but charge a rate of interest to you. I will charge a rate of interest. But now the concept is, on what basis did you decide this rate of interest? Right? Until very recently, it was a concept of MCLR, marginal cost of funds based lending rate. Right? MCLR was an internal benchmarking. Remember this. All these are internal benchmarking. Right? What do you mean by internal benchmarking? RBI provided certain parameters to the banks. RBI gave certain parameters. The banks used the parameters and the banks decided their lending rates. The banks themselves decided their lending rate. RBI did not decide for the bank. The banks decided their lending rate. For example, in case of MCLR, the marginal cost of funds was a parameter. Negative carry on the CRR was a parameter. The concept of tenor premium was a parameter. Operational expenses was a parameter. So RBI gave these parameters and the banks took those parameters, decided their own lending rate. But in case of external benchmarking, remember the concept here. A lending rate of a bank will be decided or will be linked with, let's say, repo rate. This is the benchmark. Most of the banks are using this particular benchmark, repo rate. Is this the only benchmark available? Absolutely no. RBI says you can use repo rate, you can use the yield rate on 91-day treasury bill, yield rate on 182 days treasury bill, or any parameter that has been prepared and published by Financial Benchmarks of India Limited. 4 options are there. Most of the banks have chosen repo rate. Now I've linked my rate of interest, lending rate, to repo rate. If repo rate increases, my rate of interest increases. If repo rate decreases, the rate of interest on the loans will decrease. Why I'm discussing so much? Very simple reason. Couple of days ago, I'm pretty sure all of you have read this in the newspaper. RBI, in a surprise move, increased repo rate. And soon after that, if you have been reading newspaper, you will also come across this article which says Bank A, B, C, D also increased their lending rate. Why? Because they are following concept of external benchmarking. They are following the idea of external benchmarking. Now, look at the statements. The MCLR is a method of external benchmarking of lending rates. No, it is an internal benchmarking. The external benchmarking is the recommendation of Rangarajan Committee. No, Janak Raj Committee. Third, in external benchmarking, interest rates are linked to benchmark rates, either 91-day, 182 days treasury bill yield rate, any parameter which is published by FBIL, or repo rate. 4 options? Yes. Right, we are going to link it to an external benchmark, and the interest rates will keep on changing when the benchmark will keep on changing. So right option for this particular question will be option C. Next question. Consider the following statements regarding CBDC, Central Bank Digital Currency. CBDC has been there in the discussion. Very recently, the budget also, Government of India has stated that we will start introducing the concept of digital currencies. Now, the 2 statements that I have given are, these will be decentralized. CBDCs are decentralized. Statement 1 is wrong. I'll explain that. Second, these are digital form of the fiat money. Statement 2 is correct. The term fiat money is used here. Please be very, very careful. Fiat money simply means this is the currency which has its value, or this particular money has a value because of government order. For example, if I simply take out my purse and show you a piece of paper and I say this is 1000 rupees, you will not agree as long as the 1000 rupee note, or let's say 2000 rupee note, right? The 2000 rupee note correct color is there. There is a RBI governor's signature, right? 2000 term is written, etc. You will look at the security features. Why will you agree that this piece of paper has a value of 2000? Because Government of India says so. Government of India through the order will simply say this currency or this particular piece of paper is equal to 2000. You'll simply close your eyes and say yes sir, right? Yes, you are correct, it is 2000. Right, let me give you another example. 2016, right? 2016, I'm pretty sure you have experienced, I have experienced this. Government of India overnight basically said 500 rupee note, 1000 rupee note, demonetized. Meaning what? Whatever order I've given, whatever order is there, because of which they are having the value, I'm withdrawing this particular order. which means these are merely pieces of paper now that nobody will accept in the market for conducting transaction. That is the basic idea of a fiat money. These are digital form of the fiat money. Yes, this particular statement is correct. Right, as per the proposal now, right, there is no CBDC which has been released as of now in case of India. As per the proposal, the CBDC, digital currency, will be the form of fiat money, digital form of the fiat money. For example, rather than keeping currency in my purse now, if the digital currencies are issued, in my account digital currencies would be there. I can simply conduct a transaction and make a payment in terms of digital currency itself, or I can simply pay you digital currency, you can give me cash like this. That is a basic idea of a CBDC. Some of you might be thinking, sir, why is the government of India, or let's say RBI, proposing CBDC in the first place? For a very simple reason, if they can shift to CBDC, cost of printing and maintaining currency notes will be very, very low. Right now we are printing the currency notes, we are minting the coins and we are issuing them. There is a cost for that. If you shift to a digital currency, the cost will be very, very negligible. We can reduce the cost. That is very, very important aspect related to CBDC. Now, what is this idea for decentralized? Right, understand this. In case of currencies, any currency issued by the central banker, these are centralized currencies. Whereas if you talk about, let's say, the blockchain technology, using blockchain technology, certain currencies or certain coins which are there, for example, bitcoins, right, or for that matter, any other currencies which are there in the market currently, these are decentralized. The basic difference between centralized and decentralized is that in centralized, there is a central authority which issues the currency, and any transaction, this authority, that is banking, will be one of the parties. For example, today I want to transfer money to you. I want to transfer money, right, let's say through digital banking, or let's say mobile banking, or right, any other methodology. There is always an intermediary, that is bank, right? So this is a basic idea of a centralized currency. When you say decentralized, there is no issuer, right? There is no single issuer here. There are multiple issuers, right, in the market. That is the concept of decentralized currencies. So this first statement is wrong. Second one is correct. Right option for this question will be option B, only 2. Let me go to the next question. Consider the following statements. The recapitalization by the center in the PSBs, by the way, public sector banks, has been consistently rising in the last 5 years. Trend-based question. Second statement, the recapitalization bonds are zero coupon bonds. First statement is basically a trend-based question. What has happened to the recapitalization bonds? Have a look at the graph, you'll understand. Has the recapitalization done by Government of India in the last 5 years, has it consistently increased? Absolutely no. For some of the years, there was a sudden spike in the recapitalization, and after that, there is a sudden decline in the recapitalization done by Government of India. Now, what is the idea for recapitalization? In simple terms, Government of India will be infusing, putting more capital into public sector banks. Why? Earlier, the situation of the public sector banks was very fragile. That is, the PSBs were incurring a lot of losses and the NPAs were very, very high. Because Government of India owns majority of the stake in the PSBs, government was infusing capital into these particular PSBs. But in recent times, especially in the last 2 years, the situation of the PSBs has improved. As a result of this, the recapitalization done by Government of India obviously has come down. So first statement, recapitalization by center in the PSBs has been consistently rising in the last 5 years. Statement 1 is wrong. Recapitalization bonds are zero coupon bonds. Now what is this idea of a zero coupon? Understand this. Whenever you talk about zero coupon, it simply means these instruments carry zero interest rate. Remember this. These particular instruments carry zero interest rates. Right? What is this interest rate? For example, imagine your Government of India. Right? All of you will be very happy now. Imagine your Government of India. Now you want to borrow money. Right? That is a bad situation. You want to borrow money. Right? Some of you will say, no sir, I will not borrow money. Right? That is very, very difficult to say for a very simple reason. Look at Government of India. Expenditures are very high. Revenues streams or incomes are very low. Right? Or let's say comparatively lower. you don't have any option but to borrow money. So you want to borrow, so what you will do, you will issue a bond. Bond is a debt instrument. And when you issue the bond, what you will say is, right, so please take this particular bond, give me 100 rupees. Annually, I will give you 6% rate of interest. Annually, I will give you 6% rate of interest. I am using the term rate of interest, but in the context of the bonds, remember this, the term is coupon rate. Right? In case of bonds, the technical term is coupon rate. So you will take the 100 rupees from me for a certain number of years, and annually you will pay me 6 rupees like this. That is the concept of coupon rate. But whenever you talk about zero coupon bonds, which by the way can be issued by the private sector companies as well as by government also. The zero coupon instruments simply means these instruments do not have any interest rate. There is absolutely zero interest rate on this. No interest rate is there. For example, treasury bills. Remember this. Treasury bills which are issued by the central government are zero coupon instrument. These are zero coupon instrument. Right? I am not using the term bond here. Remember this. Bond generally means having a maturity period of more than 1 year. Bonds generally means more than 1 year maturity. Treasury bills, no, these have a maturity period of up to 1 year. So treasury bills are issued in the form of zero coupon instrument. How? Imagine the value of treasury bill is 100 rupee. Government will not issue at 100, rather they will issue at 90 rupees at a discount. And after maturity period, let's say 91 day, 182 days, whatever the maturity period is there, after the maturity period, government will give you 100 rupee. That is a basic idea. But in the context of recapitalization bonds, initially Government of India issued certain bonds with interest rate. But later, right, in the last couple of years when these particular bonds were issued, these were issued in the form of zero coupon bonds. That is, government will issue the bond, collect 100 rupee from the bank, doesn't pay any interest on this. Absolutely no interest. No interest, zero coupon bonds. So have a look at this. The recapitalization bonds are zero coupon bonds. Statement 2 is correct. Right option is option B. Okay, right option for this question will be option B. Let me go to the next question. Which of the following will reduce the deficit in the budget? There is a deficit. Deficit means what? You are spending more, you are collecting comparatively lesser. If you are spending, let's say 30 lakh crore rupees, your amount that you are collecting is below 30 lakh rupees. 30 lakh crore or 30, right, the 30 lakh rupees, doesn't matter. You are spending more, compared to that, you are collecting lesser amount of income. That is called as a deficit. So if there is a deficit, what can be used by the government to reduce this particular deficit? First one is selling dated securities. What is the meaning of dated securities? Please understand this. Whenever you talk about government securities, these are divided into two parts. Okay, government securities are divided into two parts. I am using the term government securities. In case of USA, these are called as treasuries. In case of UK, these are called as gilts. G-I-L-T-S. Don't say, sir, you made a spelling mistake. Not G-U-I-L-T. That is not that gilt. This is a different gilt, G-I-L-T. Gilts is a different term. Don't get confused. In case of India, we simply use the term G securities. These are divided into two types based on maturity up to 1 year and more than 1 year. Up to 1 year and more than 1 year. And whenever these are having a maturity period of up to 1 year, we will call them as treasury bills. And more than 1 year, we will call them as dated securities. Dated securities. Now look at the statements here. Selling dated securities. If Government of India sells bonds, which are nothing but dated securities, will the government be able to control the deficit, bring down the deficit? Yes. Definitely yes, they will be able to reduce the deficit. Second, disinvestment. Right, through disinvestment also, government will raise a lot of money. They will be able to reduce the deficit. Third one, counter-cyclical fiscal policy during recession. Look at the statement here. Counter-cyclical fiscal policy during recession. During recession, What do you mean by counter-cyclical fiscal policy? During recession, when you say counter-cyclical fiscal policy, it means government expenditure is increasing. Government is increasing the expenditure. And how can you reduce the deficit? Right? You can reduce the deficit either by controlling expenditure or increasing your income. Very simple logic. Right? Don't say, sir, how can you reduce the deficit through expenditure side? You can reduce the expenditure. Right? Imagine you have expenditure of 100 rupees, the income of 90 rupees. Deficit is how much? 10 rupees. Now, what measures you can use to reduce the deficit? Increase the income, deficit will come down. Or income is same, but expenditure will come down, deficit will come down. But during counter-cyclical fiscal policy, what will happen? Government expenditure will increase. Government expenditure increases, and on the other hand, the taxes will be reduced. That is the policy during the recession, counter-cyclical fiscal policy during recession. Because counter-cyclical fiscal policy during recession will be used to overcome the issue in the economy, to promote recovery in the economy. How can you promote recovery? You will have to spend more money, you will have to reduce the tax rates in the economy so that people will have more money in the form of disposable income, purchase more and more goods and services. So when the tax receipts or taxes are reduced, what will happen to tax revenue? Lower. When your expenditure increases, what will happen to deficit? Deficit will increase. Deficit will increase. So third one will lead to increase in the deficit, not reduction in the deficit. 1 and 2 are correct. Right option for this particular question will be option B, 1 and 2 here. Next, consider the following statements regarding public debt. Okay, consider the following statements regarding public debt. What are the statements? 1. Public debt in India exhibits a low currency risk. Okay, public debt exhibits low currency risk. Second one, most of the public debt is held by the public sector banks in India. Right? What are these particular statements? Technical, yes, but look at this. Whenever you come across the term public debt, remember this. Public debt simply means they are talking about the debt of the central government. The debt of the central government. But is it the complete definition? Absolutely no. Don't be confused here. It is the debt of the government which is charged on Consolidated Fund of India. I will repeat the statement. It is the debt of the government which is charged on Consolidated Fund of India. Simple meaning, it is the debt which is repaid by the government by taking the money from Consolidated Fund of India. Sir, why so much technical definition are you telling me? I will tell you the reason for this. One term is a public debt, another one is general debt, and the third one is overall debt of the central government. Overall debt of the central government. You will feel all the three are one and the same. But no, all the three are completely different. All three are completely different. First, public debt means what? It is the debt of the central government which is charged on Consolidated Fund of India. What overall liability or overall debt of the central government? How it is different from the public debt? Because there is one more account called as public account. Public account. I'm pretty sure all of you have heard of this. That is, if you contribute anything in the form of public provident fund, it will come here. If you contribute anything in the form of, let's say, other form of small saving schemes, all of them will be contributed right to this particular account as such. And please understand, whatever is the collection done under this, Government of India is the liable party. Government of India holds the liability of repayment. I can understand Government of India is liable to make this particular repayment. So have a look at this. Government of India has taken the money, they are supposed to repay. Some of the funds have been collected in the name of the government. Government of India is supposed to repay. So this is also repayment, this is also repayment. So when I say the overall liabilities of the central government, I am counting this as well as this. I will write the number so that you understand. Overall liabilities of the central government simply means 1 as well as 2. In fact, there was the third parameter also. Extra budgetary resources, EBRs, extra budgetary resources. Government of India very recently has discontinued the concept, right? If you look at the budget documents now, Until last couple of years it was started, right, and in the last 2 years or 3 years the concept has been used by the government. But last year whatever EBRs were there, Government of India has repaid it. They want to phase it out now. So public plus, right, or 1 plus 2 is the overall liability of the central government. But right now the question is only on the public debt. Please be very, very careful. Now what is this general debt? General debt simply means C plus S. The debt of the central government as well as the states. The debt of the central government as well as the states, right? They will use the term general debt. For example, if you have been reading the newspaper, they will say that general debt in case of India is around 90% of GDP. General debt in case of India is around 90% of GDP. What does it mean? Both the central plus states have a liability of repaying 90% of worth of liabilities as such. That is the basic concept. Please be very, very careful with respect to these technical terms. First statement, public debt in India exhibits a low currency risk. Right? What do you mean by this? Whatever has been the borrowing of Government of India in the form of public debt, the borrowing is done from external sources as well as internal sources. External sources as well as internal sources. Majority of the borrowing is in the form of internal sources. I repeat, majority of the borrowing or majority of the public debt is internal in nature. And because it is internal in nature, basically it is counted in the form of rupee, it is repaid in the form of rupee. But when you have external debt like this, right, sir, what do you mean by external debt? Government of India will borrow from, let's say, World Bank. Government will borrow from another country. Government will borrow from New Development Bank. These are nothing but external liabilities like this. But most of the debt today that Government of India has is internal in nature. And what do you mean by currency risk here? If you have borrowed in external currency, that is, let's say in dollars, you cannot print dollars in India. I can understand this. Why does government prefer internal debt over external debt? Because anything is debt. Anything is money that you have borrowed. You can prefer internal debt or you prefer more of internal for a very simple reason. You can print currencies and give it to the people, right? Give it to the lenders that have given loan to you. But you cannot print dollars. Some of you might be thinking, sir, RBI is there, printing machines are there, printer ink is also there. Why don't we print dollars? You do not have the right to print dollars in India, right? So internal debt is majority of the debt. Sir, how much? Generally around 93 to 95%. From one year to next year it will keep changing, but generally it will be in the range of around 95%. Around 95% of the debt of the government is internal in nature. And because it is internal, it is in rupees, you can easily repay. So first statement, public debt in India exhibits a low currency risk. Statement 1 is correct. Second statement, most of the public debt is held by the public sector banks in India. What do you mean by this? Whenever government borrows under the concept of public debt, the most favored methodology is they will issue G securities. They will basically sell G securities. Now, who will hold these particular G securities? That is the meaning of the term. Most of the public debt is held by public sector banks. Understand this? Yes, a certain amount of G security is held by the banking sector, right? Why the banks will hold? Go back to the basics. There's a concept of SLR, statutory liquidity ratio, right? There's a concept of liquidity coverage ratio, right? So banks will hold certain amount of G securities. But please understand, as per the latest information, the amount of G securities held by the banking sector is somewhere around 30%, not more than that, around 30%. Another 30+% is in the form of the G securities held by pension funds, insurance funds, mutual fund companies, and around 16 to 18% of the bonds are held by RBI, Reserve Bank of India. So the statement is most of the public debt is held by the public sector bank. Statement 2 is wrong. So first statement is correct. Right option will be option A here. Okay, right option is option A. Next question. Which of the following securities can be invested in the RDG platform? Last week or in the last class, we have discussed what is the concept of RDG. I left out one part there, that is what kind of securities can be invested or purchased through the RDG scheme as such. RDG, by the way, stands for Retail Direct Gilt. RDG stands for Retail Direct Gilt, right? A scheme which has been launched by Reserve Bank of India. So using this particular scheme, what kind of securities can you purchase, right? What kind of the instruments can you purchase, right, under this particular scheme? Government of India treasury bills, treasury bills, can you purchase them? Yes. Second, Government of India dated securities, can you purchase them? Yes. Both of them you can purchase under this particular scheme. Third one, state development loans, SDL, state development loans. Can you purchase SDLs under the RDG? Statement 3 is correct. By the way, please understand this. Treasury bills in case of India by nature are having less than 1 year maturity. I'm pretty sure all of you know this now. Treasury bills have less than 1 year maturity, and treasury bills are allowed to be issued only by the central government. Only central government in India issues treasury bills. State governments are not allowed to issue treasury bills. So in what way the state government will issue instruments then? Bonds. They will issue bonds in the market which are famously referred to as state development loans. SDL, state development loans. Remember that. Next, a sovereign gold bond. Can you purchase sovereign gold bond using RDG scheme? Yes, you can purchase sovereign gold bond. And by the way, this concept of SGB is also there in the newspaper. Please have a look at it. Sovereign gold bonds are nothing but instruments which are issued by the government. These are the type of G securities. Very simple. These are type of G securities. Why is Government of India issuing these G securities? Government of India says people in India are fond of gold. You are fond of gold. I am fond of gold. Right? Everybody in India is madly running behind gold. In fact, in your own homes you must have seen, every month there will be one good day in the calendar to purchase gold. Right? People do that in India. We are one of the largest consumers of gold in the international market, closely following China. China is the largest consumer. After China, we are there. But the problem with gold in India, please understand this, right? Because it is there in the current affairs, I am explaining this. Problem with the gold in case of India is, gold is imported. Most of the gold that we are going to consume in India is imported. And in case of India, the gold market, the pricing of the gold is not very well developed. That is the reason they will use a statement. We are gold price receivers. We are not the setters of gold prices. India is a receiver of a gold price. We are not the setters of gold price. You need to remember all of these particular points because there is one more instrument attached to gold, concept of gold ETF, right? There is this idea of a gold ETF. There is the idea of a gold exchange market also. I'll come to that. Just give me some time. So sovereign gold bonds, SGBs. Can you purchase SGBs using this particular the retail direct gilt facility? Yes, you can purchase them. So 1, 2, 3 and 4 are correct. Right option for this particular question will be option D. All of these can be purchased under the retail direct gilt facility. Next, which of the following would have an impact on the yields on the government bonds, right? Or which of the following will impact the yield of government securities? I have given two tools here. One is a GSAP, second one is Operation Twist. And by the way, both of them are there in the current affairs. For example, GSAP, RBI used this particular tool. Twice in 2 quarters, RBI used this particular tool, and very recent in the monetary policy stated, we are going to discontinue GSAP. We will not be using GSAP henceforth. We are going to discontinue GSAP. Right now, what is this idea for GSAP and Operation Twist? Simple understanding. I don't get into the details now. Simple understanding. GSAP simply stands for Government Securities Acquisition Program. GSAP stands for Government Securities Acquisition Program. Right? Look at the name itself, you'll understand. Acquisition Program. Meaning what? RBI will purchase the G securities from the secondary market. I repeat, RBI will purchase the G securities from the secondary market. Right, sir, why does RBI purchase? Simple. Right, have a look at this. Just follow the sequence here. Don't crack your brain. Don't worry about right how this happens, sir, etc., etc. Because I'm pretty sure some will get stuck up at one point. The point is market price and yield rate. It is not the time to have a detailed understanding of market price or yield rate. Why? One, UPSC will not ask you how the calculation actually happens. And second one, technical calculations, you don't have to mug it up. Simply understand this. If the demand for something rises up in the market, if you start demanding more and more of a certain product in the market, what do you think will happen to market price? What do you think will happen to market price? If the demand rises, market price will also rise, right? And remember one more equation here, simple, right? Remember this directly. The market price is inversely related to the yield rate of the bonds. The market price is inversely related to yield rate of the bonds. That is, if the market prices will increase, yield rates will come down. If the market prices will decrease, yield rates will increase, right? That is a simple equation. Remember that, more than sufficient for UPSC. Now under GSAP, what RBI does is, RBI will start purchasing government securities. RBI will start purchasing government securities and RBI will give a timetable. That is the beauty of GSAP. RBI says within 3 months, I will repurchase so much value of government securities. That is the essence of GSAP. Why does RBI do that? If RBI purchases the government securities, demand for the government securities will increase, market prices will increase, and the yield rate on government securities will fall. Now, when the yield rate will fall down in the market, it will become easier for Government of India or the state governments to issue more bonds and borrow at a lower rate of interest. But more importantly, does GSAP have an impact on the yield rate? Yes, statement is correct, right? GSAP will have an impact on the yield rate of government securities. Second, what about operation twist? In case of operation twist, similar sequence but slight change. What happens in operation twist? Simultaneously, remember the statement here, simultaneously RBI purchases and sells government securities. Simultaneously, RBI purchases and sells government securities. RBI will purchase long-term G securities and RBI will sell short-term G securities. And when RBI will purchase a long-term G securities, that is a 10-year G securities, what will happen to demand for the G securities here? Demand for these G securities will rise up. What will happen to market prices? Market prices will increase. What will happen to yield rate? Yield rate will come down. So during operation twist, will it have an impact on the yield rate on government securities? Yes, it will also have an impact on the yield rate of government securities. 1 and 2 both are correct. Right option to this particular question will be option C, both 1 and 2. Right, both are correct. Right option will be option C, both 1 and 2. Next question. Consider the following statements regarding Masala bonds. These are rupee denominated bonds. These are part of ECB. ECB, by the way, stands for external commercial borrowing. External commercial borrowing. Now, what is this idea of a Masala bond? Masala bonds are rupee denominated bonds which are issued outside India. I will repeat the statement here. Masala bonds are rupee denominated bonds which are issued outside India. Right, now what is the concept here? Imagine here is a company in India, by the way. This company will borrow or take a loan from external market. Right, can they do that? Of course, yes, they can do that because RBI has a route called as external commercial borrowings under ECB. Any company which is eligible to attract foreign direct investment can use this particular ECB route to borrow from external market. For example, they can take loans from foreign banks, that is from outside India. They can issue bonds outside India and take the loans like this. It is allowed under ECB. But generally when you borrow like this, there is one concern, that is currency risk or exchange rate risk. Imagine you have borrowed $1. Today the exchange rate is $1 is equal to 60 rupees. And you are supposed to repay this particular borrowing, let's say after 3 years. And after 3 years, the exchange rate is $1 is equal to 70 rupees. Which means you are paying more number of rupees. Simple. Which means because of rupee depreciation, you are paying more number of rupees to the international market now. right? That will basically become a burden for Indian companies when they borrow in foreign currencies like this. Now, to overcome this particular issue, Government of India, or RBI to be more precise here, is promoting the concept of Masala bonds. It is promoting the concept of Masala bonds. What happens in a Masala bonds? Same company will issue bond in the USA market. Example, it will issue a bond in the USA market, but these particular bonds will not be denominated in dollars. These bonds will be denominated in rupees, meaning the bond will be sold to the investor, money will be collected in the form of rupees, and the repayment that is supposed to be done, either interest rate or the coupon rate or the principal amount, repayment will also be done in rupees only, which means the exchange, right, that is from dollar to rupee, it is the burden of the investor, not the burden of the borrower. If I am borrowing from USA, imagine you are sitting in USA. In earlier case, first case, I will give you bond, I will collect dollars, but under Masala bonds, no. I will give you bond, I will collect rupees from you. Who has to convert rupee to dollar? It is your headache. What is the advantage here? Advantage for me is, because I've borrowed in rupees, I repay in rupees. What happens in the exchange rate doesn't matter. What happens to exchange rate doesn't matter. I'm going to repay in rupees only. Right? But now question will be, you will ask me, sir, why should I invest then? If I'm bearing the exchange rate risk, why should I invest? You will invest for a simple reason. The Masala bonds will carry higher interest rate or higher coupon rate. The Masala bonds carry higher interest rate or higher coupon rate. That is the pull factor for you. This is the basic idea of Masala bonds. Right? Have a look at this. These are rupee denominated bonds. Statement 1 is correct. These are part of ECB, external commercial borrowing. Statement 2 is also correct. And one more point here, remember this. Whenever you talk about ECB, external commercial borrowing, the borrowing can be done either in the domestic currency or in foreign currency. Remember this. The borrowing can be done either in the domestic currency or in foreign currency. You can borrow in the form of rupee outside India. You can also borrow in the form of, let's say, dollars, euros, pounds from outside India. That is the basic idea of external commercial borrowing. Done? Right? So, both the statements are correct. Right option will be option C, both 1 and 2. Next question. The term front running, often appearing in the news, is dash. We'll have to fill in the blank. I will tell you the reason why it was there in the newspapers. There were certain stockbrokers, or at least let's say experts, who kept on giving free tips to certain investors in the market. And what was the logic for them? Right? Although they were giving free tips to these investors, there was a hidden agenda. There was a hidden agenda of these particular investors. The stockbrokers or the experts. The idea is, let's take a simple example so that you understand. Imagine I'm owning shares of, let's say, Paytm. Right? I'm owning shares of Paytm, and I will give the tip to you. Again, hypothetical situation. Please don't do this. Please don't do this. I'm owning the shares of Paytm, and I want to sell this particular Paytm shares. What I will do is, because you are all following my video, I'll simply tell, in the coming days, the Paytm shares will rise up. Please purchase. Today the price is X rupees. Purchase. In the next 1 week, the price will be higher. You can sell and book profit. But why I'm doing that? I am doing that because I already have these particular shares. I want to sell them to you. So by looking at my statement, by following my statement, tomorrow when the market opens up, all of you will start booking or purchasing the shares of Paytm. So what I will do? I am holding the shares of Paytm. You will start demanding the shares of Paytm. The market prices of the Paytm shares will increase, right, which is not going to happen now. The market price of the Paytm shares will increase. I am holding the shares. I will sell it to you. I will simply sell it to you. So this particular process is called as front running. This process is referred to as front running, and this was there in the current affairs because SEBI, which is a market regulator here, found that in various telegram groups, there were various telegram groups where the investors were being misled like this. experts who had opened up this particular group said that we'll give you tips, right? Because if you go to a broker, if you get advice from anybody else, for example, Mr. Rakesh Jhunjhunwala, you'll have to pay money. It is not free. You'll have to pay money. But here I will give you free advice, right? So use this particular facility as such. So there were more than 50,000 subscribers, 60,000 subscribers within this particular group or members within the group. I will give you this particular tip. You will go to the market, act on the tip. I will sell the shares to you, which I am holding when the market price will increase. This process is called as front running, and it is illegal, by the way. It is illegal. Why it is illegal? Right? Some of you will say, sir, but Mr. Rakesh Jhunjhunwala is giving a tip. Why it is illegal? Stockbrokers are there. They are also giving us the tip. Why it is illegal? It is illegal because SEBI says you want to give a tip, you want to give an advice. Register. Become a registered member. Then you can keep on giving tips like this. But without being a registered consultant or an advisor like this, you are not allowed to give these stockbroking tips as such. So that is the concept of front running. It was there in the newspaper. Please be very careful. So the term front running, often appearing in the news, is associated with what? A particular country taking lead in clean technologies. No. Developed countries leading the economic recovery. No. Investor or broker joining the trade in the market because of access to information affecting the asset prices. Statement C is correct, by the way. Okay, statement C is the correct definition of front running. Okay, it was there in the context of SEBI, right, penalizing many of these particular stockbrokers. Please be very, very careful with respect to these terminologies. Next question. Consider the following statements. Green bonds can be issued by companies, governments and multilateral organizations. What do you mean by green bond? Green bond is a type of a bond. It is a type of a debt instrument. But look at the name, there itself will understand the meaning of the term green bond. It simply means anybody who issues the green bond is saying that the money that I am going to collect will be used for specific type of projects. Is it okay? I'll repeat it. The one who is issuing this particular green bond is essentially saying this money will be used for specific type of projects. What kind of projects? For example, wind energy projects, right? Solar energy projects, etc. In simple terms, those which will protect the environment, which are environment friendly projects. Those are the projects where the money that is collected by issuing these bonds will be utilized. And this concept of a green bond is there in the last couple of months in the discussion for a very simple reason. Government of India in the budget has stated we want to issue sovereign green bonds. We want to issue sovereign green bonds. What do you mean by sovereign green bond? Whenever the government issues these particular green bonds, these are called as sovereign green bonds. Simple. When government will issue these bonds, these are called as sovereign green bonds. So understand this, as of now this has not been done, but once it is done, it will be for the first time that Government of India is issuing green bonds. It will be for the first time. Having said so, within Asia, within the Asian member countries like this, or within Asia as such, will India become the first member to issue sovereign green bonds? Absolutely no. That statement is there here. Statement is there. With the issuance of sovereign green bonds, India will become the first country to do so in the Asian, the continent as such. Absolutely no, this will be wrong. Indonesia has already done it. Bhutan has already done it. India will not become the first country, by the way. So third statement is wrong. Third statement here itself is wrong. Right? So green bonds can be issued by companies. Yes. Any example? Ford company has issued green bonds. Governments, yes, many countries, governments have actually issued sovereign green bonds. And multilateral organizations, even this statement or this part of the statement is correct. Example, World Bank. World Bank is one of the major or leading issuer of green bonds as such. So first statement is correct one. Egypt is the first country in the Middle East and North Africa to issue a sovereign green bond. It is just a factual information. right? This statement is also correct, right? This was there last year in the discussion. The second statement is correct. Third one, by the way, is wrong. So 1 and 2 are correct. Right option will be option B here. Okay, right option will be option B. 1 and 2, first and second statements are true. Let me go to the next question. The term IPO financing often appearing in the newspaper refers to what? I will tell you the current affairs article where you would have come across the term IPO financing. Not specifically IPO financing, because you would be focusing on something else. I am pretty sure all of you know what was the issue, right, surrounding the concept of Mr. Ashnir Grover's call that he made to one of the managers. I am pretty sure, right, most of you heard of it, most of you even heard to the recording, you have scolded, you have took the side of him, etc., etc. Whatever your viewpoint, don't worry, I am not going to not test you here, or I am not going to judge you. My focus is on the term IPO financing. The whole recorded version of the call was focused on the concept of IPO financing itself. What do you mean by IPO financing? Have a look at this. Imagine there is a company XYZ which is going for an IPO. Now what is an IPO? IPO means initial public offering. I'll repeat, right? The term is also very important. Why? In the last 1 year, more than 20 companies in case of India have actually gone for an IPO. The biggest in the last couple of years was the IPO of the Paytm, right? I believe some of you have already invested in the Paytm and now are regretting it. The most recent one is LIC, right? The IPO which is being conducted now. So IPO simply stands for initial public offering. But what do you mean by that? Term expansion, very good sir. I know that I've mugged it up. But what does the term mean? The term IPO simply means that a company, the shares of this particular company now will be available in the market for trading purposes. You'll have to remember the full statement. The company's shares are available in the market for trading purposes. That is important. Why? Until now LIC, right? The ownership of LIC was there with government. Now once the IPO is conducted, you can have the shares of LIC, I can have the shares of LIC, we can sell and purchase the shares of LIC from the market. That is, let's say Bombay Stock Exchange. Right? Whenever the company shares are available in the market for trading purposes, we use the term IPO. That is, the company goes through IPO, initial public offering, makes the shares available to the investors who can trade these particular shares. That is the concept of an IPO. But what do you mean by IPO financing? Let's go back to the example. Imagine there's a company XYZ which is going for an IPO. I want to invest in the shares, purchase them, sell them and make profit. Very simple. I want to subscribe, purchase the shares, sell them in the market and make profit. But I don't want to invest my own money. I don't want to invest my own money. In that case, there is a term called as IPO financing. What the rich people or these big investors, what they do is, they will take a loan from a bank, they will use that money to purchase the shares, and when the shares are listed, when the IPO is conducted, shares are listed, these investors will simply sell the shares, because generally if there is a very high demand for the shares, initially when it gets listed, market price will start increasing. Market price will start increasing. Imagine through the IPO process, I purchased the share at, let's say, 900 rupees. But once the share gets listed, the market price of the share is 1000 rupees. So I will sell the share. I bought it at 900, I sold it at 1000. I made a profit of 100. So these big investors want to make the utilization of this. They don't want to invest their own money. They will take a loan. They will take a loan so that they can purchase the shares when the IPO is conducted. And when the shares are listed in the stock market, they can sell the shares, make profit. Right? This particular process is called as IPO financing. Getting access to finance to subscribe to the shares under IPO. Right? The right option for this particular question is getting access to the finance to subscribe to the shares under IPO. And apart from the issue of Mr. Ashnir Grover's phone call, this was also there in the newspaper, because now RBI simply says whenever you talk about IPO financing, there should be a limit. Right? There should be a limit of how much loans you are going to give under IPO financing. Now the limit has been fixed at 1 crore rupees. Under IPO financing, the limit has been fixed now at 1 crore rupees. Right, earlier these limits were not there, now there is a limit of 1 crore rupees. So remember this. Then this is the answer to the question here. By the way, the right answer is option C. Next question. Consider the following statements regarding ETFs, exchange traded funds, very often cited in the newspaper. I'll give an example. Silver ETF, that was discussed. Gold ETF. In NSE, National Stock Exchange, 100th ETF was listed very recently. So the term very often is cited in the newspaper. Please be very, very careful. Which of the following statements are basically correct? Let's start. ETFs can be issued in case of commodities, stocks and bonds. First and foremost, what do you mean by an ETF? Exchange traded fund. ETF simply stands for exchange traded fund. And what do you mean by exchange traded fund here? Exchange traded fund is a basket of security. Remember this, it is a basket of security. Right, what do you mean by basket? Right, imagine you will go to a shop, a supermarket, right, more, whatever it is. Whenever you want to purchase more and more goods, you will carry a basket. In the basket, you will start putting goods. Apply the same logic. Basket here means it is a collection. It is a collection of securities. ETF is not a single instrument. Understand this. Within ETF, there are multiple instruments like this. The combination of these instruments is referred to as ETF. Exchange traded fund is a basket of securities which is traded just like a stock, which is traded in the market just like a stock. That is, you can purchase the shares of Paytm company, you can sell the shares of Infosys company. In the same way, you can purchase ETF, you can sell ETFs because these are listed in the stock market. Done? This is a basic idea of an exchange traded fund. Now what is there here? ETFs can be issued in case of commodities, stocks and bonds. Yes, it is correct. Are there any commodity ETFs? Gold ETF, it is a commodity ETF. Silver ETF is a commodity ETF. Stocks, right? Are there any stocks ETFs? Best example, central government has issued 2 equity ETF. Remember this. Central government very recently has issued 2 equity ETFs. Equity means these ETFs will consist of basket of shares. One is CPSE ETF and the second one is Bharat ETF, right, or Bharat 22 ETF. Both of these are equity ETFs. The ETFs will consist of shares. Has the central government issued any debt ETF, bond ETFs? Yes, there is a debt ETF which is issued by the central government, that is basically Bharat bond ETF. Bharat bond ETF, right? Remember these particular terms. In case of this, shares are clubbed and these are sold in the market. Right, sir, I am unable to understand even now. Let me give a very simple example. All of you have eaten gems. This is generally the example that I give to the students. Gems, right? You will go to a shop, purchase a packet of gems, and when you open the packet, you will have multiple colored chocolates. You will see yellow is there, red is there, white is there, black is there. Right? Whether it is there or not, don't worry. But you will see multiple colored chocolate pieces within that. Right? So packet is gem, but when you open it, multiple pieces of chocolates are there. Apply the same logic to ETF. In case of, let's say, CPSE ETF, shares of various central public sector enterprises are clubbed, and this particular, right, clubbing or the basket is sold as one unit to you. Right? That is a basic idea of an ETF. Right? When you purchase an ETF, you have purchased multiple securities. When you sell ETF, you have sold multiple securities. That is the basic idea. Done? Right? So come back to the slide here. ETFs can be issued in case of commodities, stocks and bonds. Statement 1 is correct. Government of India has so far issued only equity ETFs. Statement is wrong because government has also issued Bharat bond ETF. Bharat bond ETF, exchange traded fund, Bharat bond ETF. If you purchase a Bharat bond ETF, it simply means it is a group of multiple bonds issued by the public sector enterprises. there are CPSEs, public sector enterprises, which have issued or which have a very good credit rating. They have issued bonds in the market, that is a AAA credit rating. Remember this statement also. The bonds which are issued with a AAA credit rating are clubbed under Bharat Bond ETF, are considered under Bharat Bond ETF. So when you purchase a Bharat Bond ETF, it simply means you have invested in certain number of bonds issued by public sector entities with a AAA rating. This is a debt ETF. So second statement is wrong. First statement is correct. Right option for this particular question will be option A. Only one is correct. Next question. Consider the following statements regarding electronic gold receipts. Consider the following statements regarding electronic gold receipts, EGR. Now, what is this particular concept of an electronic gold receipt? Like I've told you earlier, in case of India, we import lot of gold, we consume lot of gold. And the problem is, one, we import gold, and second, there is no mechanism to decide the gold prices in India. We do not have a very good market for price setting of gold in India. Right? To address these kind of issues, what Government of India has done is, it has proposed gold exchanges. Remember this. It has proposed gold exchanges. And remember this, the gold exchanges are just like any stock exchange. For example, we have Bombay Stock Exchange, we have a National Stock Exchange. On the similar line, we will also have gold exchanges which will come under the regulation of SEBI. Now what is this? Electronic gold receipts. Government of India says, I want to prevent the hoarding of the gold by the people here, because what all of us do is, we'll purchase a lot of gold and we'll simply keep it. We'll simply keep it with ourselves. We don't use it. We'll simply keep on hoarding gold. And as a result of this, there is a supply and demand mismatch of gold in the domestic market. To overcome all of these issues, electronic gold receipt has been provided, or the concept has been originated. What will happen in an EGR? Imagine the gold will be produced here, right? And based on the volume of the gold, the electronic gold receipt would be generated. An EGR would be generated. For example, let's take a simple example. 1 kg of a gold has been produced, and 1 kg of a gold, right, basically 1000 grams. For every 10 gram, I'm going to generate 1 electronic gold receipt. And which means 1000 grams, how many electronic gold receipts I will generate? I will generate 100 EGRs. I will basically create 100 EGR. 1 EGR is equal to 10 grams. Now what I will do? I will take this particular 1 kg of gold, submit it to depository. Remember this. I will basically take this particular gold, submit it to a depository. The physical gold will be there with the depository. And these particular 100 EGRs, I will sell them in the market. Right? Imagine you will purchase 2 of them. What does it mean? You have purchased 2 EGRs, simply means you have purchased 20 grams of gold. You have purchased 20 grams of gold. But immediately I am not going to give you 20 grams of gold. You have simply purchased 2 EGRs. Now either you can keep it. There is no maturity period for this. And please understand this. Sir, what is the advantage? It is as good as saying you have purchased 20 grams of gold, but you don't have to be worried about physical storage. Physical storage is with the depository. The physical gold is stored with the depository. Now you will have 2 EGRs. Either keep it, there is no maturity period for this, you keep it, or else you want money. So whatever is the market price of the gold, at that particular price you can sell this particular 2 EGRs to somebody else in the market, you get the money. Or else you will say, sir, I don't want the money, but I want the physical gold. That facility is also there. You will simply take the 2 EGRs, give it to the depository, and the depository will take 20 grams of gold out of 1 kg, give it to you. I can understand this? I'll repeat the process here. 1 kg of gold is produced here, and imagine 1 EGR is equal to 10 grams, which essentially means 1000 grams is there. I will have to create 100 EGRs. I will sell it to you. You have purchased 2 of them, which simply means you have purchased 20 grams of gold. But physical gold is not given, you have 2 EGRs. Now at any point of time you want physical gold, go to the depository where the gold is stored, give this particular 2 EGRs, and the gold will be given to you. Physical gold will be given to you. That is the basic of electronic gold receipts. Okay, that is the basics of electronic gold receipts. Now understand this very carefully. Do not get confused in the UPSC exam regarding this. Why? There is also concept of sovereign gold bond. There is also this particular concept of sovereign gold bond. And if you compare sovereign gold bond and electronic gold receipt, in EGR there is no maturity period. In case of sovereign gold bond, there is a maturity period of 8 years. There is a maturity period of 8 years. In case of EGR, you can simply submit or give back the EGRs and you can get equivalent value of gold, physical gold you can get. Whereas in case of sovereign gold bond, upon maturity, they will give you the market price of the gold on that day. They will not give you physical gold. Remember the differences. Don't get confused if these kind of confusing statements are provided in the prelims. Done. Now look at the statements here. The holder of these receipts can surrender or deposit these receipts and withdraw the physical gold. Allowed? Yes, it is allowed. These are recognized as a securities under Securities Contracts Regulation Act of 1956. Yes. What is the importance here? SEBI, whenever it says certain securities are recognized under this particular act, it simply means that these securities can be traded, can be sold and bought in the market. Can you sell the EGRs? Yes. Can you purchase EGRs? Yes. Both the statements are true, right? And the right option will be option C, both 1 and 2. Right option for this particular question will be option C, 1 and 2. Let me go to the next question. Consider the following statements regarding anchor investors. IPO was there in the discussion, so remember this. Another very important terminology related to IPO is the concept of anchor investor. Right? What do you mean by an anchor investor? Understand this very carefully. Whenever you discuss the concept of initial public offering, IPO, the investors in an IPO are generally divided into 3 groups. The investors or the one who will subscribe to an IPO are divided into 3 groups. These are institutional investors, second one is non-institutional investors, and the third one is retail investors. I will repeat it. Whenever you talk about investment in an IPO, subscribing to an IPO, you can divide the investors under 3 heads: institutional, non-institutional and retail investor. Institutional investors are, let's say, insurance funds or let's say investment funds, right, etc. Non-institutional investors, rich investors who will invest more than 2 lakh rupees are generally classified under non-institutional investors. What about retail investors? Example, you and me, we are referred as retail investors. Our investment in an IPO is below 2 lakh rupees. Below 2 lakh rupees. That is the reason we are classified as retail investors. Now within these investors, it is generally the institutional investors who will be issued the shares one day before an IPO is conducted. I will repeat the statement here. It is generally the institutional investors. Some of the institutional investors will be identified. They are referred as anchor investors and the shares are allocated to them one day before the IPO is conducted. Imagine tomorrow the IPO will be there. The shares would be given to the investor, but today itself these investors will be allocated shares and these investors are referred to as anchor investors. And as per SEBI guidelines, recent guidelines, the logic is simple. Anchor investors are allocated shares one day before the IPO is conducted and they are not allowed to sell these particular shares for certain number of days. Otherwise what will happen is, sir, why they are not allowed? Otherwise what will happen is, everybody wants to sell the shares in the market. After the listing is done, the supply of shares will increase to a very great extent. Market prices will crash. Market price of the share will abruptly crash like this. So the SEBI simply says for certain number of days the anchor investors are not allowed to sell these particular shares. Right now, look at the statements here. These are allocated the shares before the IPO is conducted. Statement 1 is correct. One day before the IPO is conducted. All the non-institutional investors, NIIs, are considered to be anchor investors. No statement is wrong. In fact, the anchor investors are those investors within the institutional investors. Non-institutional investors such as retail investors, or let's say the high retail investors, are not considered as anchor investors. One is correct. Right option to this particular question will be option A. Next question. The term T plus 1, T plus 2, very often appearing in the newspapers, are associated with. Right, now understand this. Very recently, in case of BSE and NSE, Bombay Stock Exchange, National Stock Exchange, we have introduced the concept of T plus 1 settlement. T plus 1 settlement system. India has become one of the countries in the global market to introduce a T plus 1 system. Is it the only country? Absolutely no. China already has this system. Many other countries tried it, they have revised it, or they basically reversed the course to T plus 2 system now. But what do you mean by T plus 1, T plus 2, T plus 3? Did we have T plus 3? Yes. Right, earlier in 2002, we actually had T plus 3. 2003, we introduced the T plus 2. And very recently, we have introduced the T plus 1. But what do you mean by plus 1, plus 2, plus 3 like this? It simply is referring to settlement of the stock market or settlement of the trade in the stock market. Right, what do you mean by this? Imagine I will sell certain shares to you, you will purchase the shares from me. Is it okay? We are entering into a transaction in the Bombay Stock Exchange. I am selling certain shares, you are purchasing certain shares. But this settlement means right now we have agreed. But when will the shares actually be transferred into your account? That generally right now takes around 48 hours. Right, or until very recently, that would take around 48 hours. Right, the transaction is done. I have agreed to sell the shares to you, but immediately the shares will not be transferred into your demat account. Right, it will take around 48 hours for the shares to be actually transferred and the settlement of the transaction to actually happen. That concept was referred to as a T plus 2. And now some of you might be thinking, sir, why will you not give me the shares at the same point of time? Why can't you simply take money and give me the shares right now? It happens because in case of the market, there are certain investors by the name of intraday traders. Intraday traders, right? What do you mean by intraday traders? I'm pretty sure many of you are actually doing that. Intraday traders means within the same day, multiple transactions, multiple trades are conducted by them. And when I said I will sell the shares to you, I may or may not have the shares right now in my hand. What I will do is, I will agree to sell the shares to you, but those shares I will purchase from someone else later in the day. So today, right now, I may not have the shares to sell to you. So in that case, how can I simply settle the transaction? That is the reason we have a settlement system of T plus 2. Right? Immediate settlement, it doesn't happen because of intraday trading. But what about the T plus 1? Now under the T plus 1, settlement will happen in 24 hours. Settlement will happen in 24 hours. That is a basic idea of T plus 1 settlement system. Right? So have a look at this. The term T plus 1, T plus 2 often appearing in the newspaper. It is associated with what? It is associated with the settlement in the stock market. Right? How the shares would be transferred, how the money is paid. The settlement is basically done under the system called as T plus 1. Right now, earlier it was T plus 2. Done? So the right option for this particular question will be option C. Right option is option C. Let me go to the next question. Which of the following authorities regulate the derivative market in India? Which of the following authorities regulates the derivative market in case of India? Now first and foremost, right, what is this concept of a derivative? Right, understand? Derivative, there are multiple types of derivatives. You don't have to mug up everything related to derivative. For example, there are future derivatives, forward derivatives, options, right, etc. Right, there are different types of derivatives as such. Basic concept is simple here. Derivative simply means, look at the term there, derivative. Derivative simply means this will derive its value from underlying asset. I will repeat my statement here. What do you mean by derivative? It will derive its value from an underlying asset. Right? What do you mean by this? Let me give a very simple example. Imagine I'm a farmer, I will cultivate certain crop, and you and me, we will enter into an agreement. What is agreement? You are entering into agreement saying that after 30 days, whatever is the price of the crop, market price, I will pay it and purchase the crop from you. I will repeat the statement. After 30 days, whatever is the market price of this crop, I will pay it and purchase the crop from you. So that is a piece of paper. Agreement is a piece of paper. But can I simply say that the value of this agreement, that is what price you will pay, what price I will collect, what money I will collect from you, depends on the underlying asset, that is the crop. Whatever is the market price of the crop, that is what you will pay, and that is the value of the agreement. Right? So this agreement is simply a piece of paper, individually doesn't have any value. It will derive its value from underlying asset. Another concept, right? Current affairs, it is there, P notes. P note is also a type of derivative instrument itself. So understand the idea here, why this particular question has been given by me. Simple. Derivative is a complicated idea. You don't have to study everything about derivative. Then you will become a trader in the market, not an UPSC aspirant. Why it was there in the newspaper? SEBI, Securities Exchange Board of India, banned trading of certain derivatives, that is agriculture derivatives. I'll repeat the statement here. Right? SEBI banned certain derivative trading in the agriculture commodities. Reason was very simple. It felt that there is a lot of speculation regarding the market price of these particular agriculture commodities. People will start hoarding of these particular the agriculture commodities, looking at the derivative prices, or looking at what is the pricing or the value of these particular derivatives in the market. It could simply lead to speculation, lower supply of the commodities in the market, contribute to inflation. So SEBI, what they did was they banned trading of some of these particular agriculture derivatives, and that is where this particular term was actually there in the newspaper. Done? So looking at that particular article, some of you would have already come to a conclusion. If SEBI can ban the derivatives, it simply means SEBI will regulate the derivatives. You are partly correct. You are not completely correct. You are partly correct. Why? Does SEBI regulate the derivative market? Yes. But will all the derivatives come under the SEBI? Absolutely no. All the derivatives do not come under the regulation of SEBI. For example, there are forex derivatives, currency derivatives, interest swap derivatives. Those kind of derivatives are regulated by Reserve Bank of India. I will repeat the statement. There are certain derivatives such as forex derivatives, currency derivatives, or interest swap the derivatives. These are not regulated by SEBI. These are actually regulated by Reserve Bank of India. So please be very careful. There are two regulatory authorities in terms of regulation of the derivatives. One is correct, two is correct. Right option will be option B, 1 and 2. Right option for this particular question will be option B, 1 and 2. Done? Okay, next question. Consider the following statements regarding co-location. Even in the last couple of days, this particular term co-location has been used in the newspaper. Right, regarding one of the farmer, right, the chairman, or let's say CEO of this particular NSE as such. What do you mean by co-location here? Understand this. Co-location in simple terms means there are NSE servers. Either you say NSE or BSE servers. There are NSE and BSE servers, right, where the traders will basically log in, put in order for trades, place order for trades, either buying certain securities or selling certain securities. They are basically placing the orders of the trades in this particular server. Now, in the vicinity of the place, right, where the servers are located, in the vicinity of this particular place, there will be certain area which will be referred to as co-location. Certain area will be identified, and this area will be referred to as co-location. And why it is identified as a co-location? Various traders can basically utilize this particular space to set up their working area. Right? The traders will have to pay certain fees either to NSE or BSE, set up their operations within this particular area. Some of you might be thinking, sir, what is the advantage? They are sitting nearer to server. What is the advantage? Advantage is very simple. Let me give a very simple example. Imagine, right? Imagine very big movie. The tickets will open up right now. Okay, the tickets will start booking, or the theaters will start taking the booking right now. Now you and your friend want to book a ticket. You are using a 5G phone which has a 4G connection. Your friend is using a 2G connection. In whose system, in whose mobile do you think the ticket will be booked much faster? Very simple, right? You are using a 4G phone, right? Or you are having a 4G technology. Your internet speed is very, very fast. Your friend is having a very old phone, one, slow processor, and second, internet speed is 2G for him. Both of you are trying to book the ticket. Whose ticket will be booked much faster? Apply the same logic here. Apply the same logic. Even fraction of a second, even if this particular trade order is a fraction of a second faster, they will get much better access, faster access to the servers in the NSE and BSE. They'll be able to place the trade orders much faster, right? Compared to other traders, because they are very close to these particular servers, they will be able to place the orders much sooner. Even a fraction of second can make a lot of difference, right? It will make a lot of difference. This particular concept is called as co-location. This is referred to as co-location. Now, look at the statements here. Both NSE and BSE provide co-location facility. Statement 1 is correct. Statement 1 is correct. Both of them are providing co-location facility. Both of them charge certain amount. Second, the co-location facility allows a high latency and fast execution to trading members. Look at the term here, latency. Latency means with what speed, or let's say with what time period gap you will be able to provide this particular service. High latency, low latency. Latency basically means, understand this, if I'm providing, right, let's say a simple example. Imagine you are standing 50 feet away, I'm standing here. If I shout to you, if I shout at you, immediately you will not get the sound, because I'm pretty sure you have read about science also. Sound will travel at 330 meters per second, light will travel at 3 lakh kilometers per second. So obviously if I let's say if I put on, let's say, a light, obviously the light will reach to you at much faster compared to shouting at you. So idea is latency here. The latency in case of sound is very high. It will take more time to reach you compared to, let's say, light. So in case of the co-location, please understand, the co-location facility will provide a low latency, very small time period gap as such. So it will provide a low latency and it will help in faster execution of the trading of the members. Second statement is wrong. It doesn't provide high latency, it provides for low latency. So first is correct. Right option for this question will be option A, only one is correct. Next question. Consider the following regarding Sarthi app. Right? Consider the following regarding Sarthi app. Right? Either they will use the term like this, Sarthi, or else right, they will also write it like this, Sarthi app. Right? What is this particular Sarthi app? First and foremost, it is launched by the Ministry of Consumer Affairs. Wrong. This is not launched by Consumer Affairs. This has been launched by SEBI, Securities Exchange Board of India. This has been launched by SEBI. First statement is wrong. Second statement, the app aims to create awareness among the investors. Yes, that is the most important objective of this particular app. You can download this particular app, for example, through Android App Store. And once you download, right, if you check it, it will basically provide a lot of information to the investor. Right, a lot of information related to how the market actually functions. Why this has been done? SEBI says that in the last couple of years, the retail investor participation in the market is actually increasing. Lot of investors are coming to the market. I want to provide certain knowledge to these particular investors, and for that purpose, SEBI has launched this particular Sarthi app. Right, so first statement launched by the Ministry of Consumer Affairs, wrong. The app aims to create awareness amongst the investors. Statement 2 is correct. Right option will be option B, only 2. Right option is option B, only 2 is correct. Let me go to the next question here. Consider the following regarding P notes. P notes or participatory notes. Sir, I've read it in the book, but you said this is current affairs. Why are you discussing? Participatory notes, there was recently an article. There has been a decline in the participatory note investment in India. Right? The investment through participatory notes has actually declined in India. That was the article. So suddenly UPSC, the question paper setter will look at it and say, okay, this is my question then. Now look at the statements here. The FPIs, foreign portfolio investments, will have to disclose the investors in the P notes to SEBI. Statement is wrong, by the way. You do not have to disclose who are the investors. First statement wrong. Second statement, P notes are issued with only equity as underlying asset. Even this particular statement is wrong. Right? They can use bonds also as an underlying asset. But what is this idea of a P note? Imagine here is a foreign investor, X. He wants to invest or she wants to invest in India. But whenever X wants to invest in India, they will have to go through SEBI. They will have to be registered with the SEBI. Only then they are allowed to invest in the Indian market. But for whatever reason, X doesn't want to be registered. Right? That doesn't want to be registered. Right? They will say consumption of time is very high. Right? Paperwork is very high. I don't want to go through this particular route. In that case, what can be done? There are FPIs, foreign portfolio investors, who are already registered with SEBI. These are already registered with SEBI. Done? That's the first point. And these FPIs will purchase or invest either in the bond market, that is a debt market, or equity market. So have a look at this. Either they will invest in the bond market, that is a debt market, or invest in the equity market, purchase instruments. Now they will keep these instruments and issue P notes. Have a look at this. I'll take a very simple idea here. Imagine this FPI has invested and purchased bonds worth 1,000 rupees. FPI has invested and purchased bonds worth 1,000 rupees. So the bonds are there with the FPI. Now they will keep FPI. They will keep these particular bonds as an underlying asset. Now we will issue 1,000 rupee worth of participatory note to the investor. Is it okay? They have purchased the bond or they can purchase the shares also. They'll keep those as underlying asset. They will issue a P note worth 1,000 rupees to X. It simply means X has invested 1,000 rupee worth of investment into the Indian market, either in the stock market or in the bond market. It is similar to the concept of depository notes. I'm pretty sure you've heard of this. It is similar to the concept of depository notes. But have a look at the concept here. In the concept of P notes or participatory note, this particular P note will be issued to the foreign investor. Money will be collected, and imagine this is an equity. This is a share. If you have a share and the share will give you certain amount of a dividend, the FPI will simply give this particular dividend to foreign investor like this. They'll simply give the dividend to the foreign investor. This idea is called as a P note or participatory note. Okay, this concept is referred to as a P note or a participatory note. And remember, this P note is nothing but an offshore derivative instrument. Offshore derivative instrument. Right? What do you mean by offshore derivative instrument? Offshore means it is issued outside India. Foreign investor is there. FPI has issued the P note to a foreign investor outside India, offshore. Why it is called as a derivative instrument? This value of the P note depends upon value of this particular bond itself. Whatever are the underlying asset, on those underlying asset, P note has been issued. That is a basic idea of a participatory note. FPIs will have to disclose the investors in the P notes to SEBI. No, this condition is not there. P notes are issued with only equity as underlying asset. No, they can even purchase bonds and issue P notes in the market. So both the statements are wrong. Right option for this question will be option D, neither 1 nor 2. Next question. Consider the following regarding e-bill system. Consider the following regarding e-bill system. Now most of you look at this e-bill and say, okay, one more question on GST. Absolutely no. This e-bill I'm talking of is not anyways related to GST. There itself the first option will be wrong. But now you will say, sir, you have read, you will tell it is not related to GST. How do I understand? E-bill system is very recently proposed by Government of India. It has been proposed by Government of India. In fact, there is one department which is called as Public Financial Management System, PFMS. Public Financial Management System Department, which is basically the authority which has developed this e-bill system. Now, what is the concept of e-bill system here? Imagine you are the government. I have supplied certain goods to you. Now you are supposed to make the payment to me. Agreed? You purchase certain goods. You are supposed to make the payment to me. Now what will happen? You are the government official. You are the secretary. Now you will say, sir, this is my turn now. Right? You want the money? Come to office. Wait for me. I will send you back 2 days or 3 days. Fourth day I will call you. I will humiliate you, etc. There was interaction with the government officials. Physical documents, bills were submitted. Face-to-face interactions were conducted with government official. That is not a transparent process. That process will get delayed. Sir, how process gets delayed? Imagine you are the government official, you are the secretary now. All of your past UPSC, you have become secretaries. Along with me, 3 more other people have submitted bills to you. You are supposed to allocate the money to all of us, clear the funds for all of us. But you will withhold my bill. You will push my bill to the back and you will clear the bills of others in the front. Whatever the reason is, don't worry about that. You will do that. Now, the government says this is not a transparent method. So, we will introduce a new method. We will introduce a new method. The name of the system is e-bill system. Okay, the name of this particular new system is e-bill system. What happens in an e-bill system? Have a look at this. I am a registered entity on the e-bill. I have supplied certain goods to you. I don't have to bring the documents and submit it to you now. Physical documents will not be required. I can simply scan the documents, that is the bills will be scanned, and these bills will be uploaded on the e-bill system. Is it okay? The bills will be scanned and uploaded on the e-bill. Now the bills will come to you and government says it will be first come, first serve. First come or first in, first out. What do you mean by this? 3 vendors, let's say A, B, C, they have submitted a bill. If A has submitted the documents first, his documents will have to be cleared first. Is it okay? If A has submitted the documents first, out of these 3, A's bills have to be cleared first. There is no scope of bias here, right? The government official will not be able to have any kind of a bias. He cannot dictate which of the bills will be cleared first, which will be pushed back. Absolutely no option now. That is a basic idea of a first in, first out system that the government of India has proposed under the concept of e-bill system. This will promote transparency. This will basically promote faceless transaction, right? It will promote the concept of paperless payment system, right? With the e-bill, these are some of the objectives. Let's start. Has been developed by GST network. Statement 1 is wrong. Will promote a faceless paperless payment system. Statement 2 is correct. Statement 2 is correct. Statement 1 is wrong. So right option for this particular question will be option B. Only 2 is correct. Right. So option B. Only 2 is correct is the right option. Done. Let me go to the next question here. Consider the following statements. Farmers can borrow only up to 50 lakh rupees against ENWRs. The ENWRs have time validity. First and foremost, what is this ENWR? Negotiable warehouse receipt. Negotiable warehouse receipt. That is NWR. Remember this. Negotiable warehouse receipt. But what is this idea for negotiable warehouse receipt? Let's start with an example. Imagine here is a farmer. Farmer has cultivated certain crop. If the farmer sells these particular crops in the market, supply of the crop is very high, market prices will be very low. But if he starts storing the crops, he will not have money. So what the farmer does? The farmer will take this particular crop, approach a warehouse, submit these particular crops in the warehouse, deposit the crops in the warehouse, and this warehouse will issue something called as a warehouse receipt. They will issue something called as a warehouse receipt. Right? Receipt means piece of paper, a document which proves that you have kept certain crops with warehouse. Now what the farmer does is, he will take this particular warehouse receipt, approach a bank, take a loan from the bank. Take a loan from the bank. Right? The warehouse receipt will be the security here. They will simply take the loan from the bank. This is the concept of warehousing receipt, which is used to get access to credit from the market. In fact, remember, there is a committee related to this, Shanta Kumar Committee. Remember the name of the committee, Shanta Kumar Committee. And this Shanta Kumar Committee recommended that Government of India should promote NWR system. Should promote NWR, Negotiable Warehouse Receipt System. Now some of you will look at it and say, sir, what if I lose the receipt? What if I lose the piece of paper? Government says, don't worry. In fact, it is RBI. RBI says, don't worry. We are not going to issue physical receipts now. We are issuing electronic NWRs. Right now, the concept is electronic negotiable warehouse receipts have to be issued. That is the reason I have written ENWR. Agreed. But what is the statement given here? First one, the farmers can borrow only up to 50 lakh rupees, right, using ENWRs. Statement 1 is wrong. Why this was there in the current affairs? Please remember this. RBI, which is the regulatory authority here, Reserve Bank of India has increased this particular limit. Today it is not 50 lakh, it is 70 lakh rupees. A farmer can use ENWR and borrow up to 70 lakh rupees using the ENWR. So first statement is wrong. Second, ENWRs have time validity. Right? Do they have any kind of a validity? How many days? How many months? Yes, ENWRs have time validity. Right? What is the time validity here? Whatever is the shelf life of the product. I repeat, whatever is the shelf life of the product, the ENWR will have the same time period validity. I'll repeat the statement here. Whatever is the shelf life of the product, the ENWRs will have the same validity or the same time period. What is the meaning of shelf life? Whenever you discuss the concept of food processing, you will come across the term shelf life. Shelf life simply means for what time period the food remains consumable. For example, if you purchase, let's say, a packet of biscuit, they will say best before 6 months, best before 9 months. If you go to the market, purchase a pound of bread, they would have written best before 4 days. That is nothing but a shelf life. So whatever crop you are storing with the warehouse, whatever is the shelf life of the crop, the receipt will have the same validity period. That is the validity period for the ENWRs. And one more very important point here, again this was there in the current affairs. The RBI simply says the banks should give loans on those NWRs which are issued by the warehouses which are registered with WDRA. I repeat my statement here. RBI says the banks should give loans on those warehouse receipts which are issued by the warehouses which are registered with WDRA. What is WDRA? Warehouse Development Regulatory Authority. Warehouse Development Regulatory Authority. And as per the latest data given by RBI, only around 10% of the warehouses in India are registered with WDRA. So RBI says a bank should give a loan on ENWRs, right? Only those which are issued by warehouse which is registered with WDRA. These are certain very important points, current affairs related to this. Please be very careful. Second one is correct. Right option for this particular question will be option B here. Only 2 is correct. Next question. Consider the following statements regarding Food Corporation of India, FCI. Very often cited in the newspaper, especially whenever food security issue is discussed, FCI will be there in the newspaper. And very recently in the context of Telangana issue, FCI was again there in the newspaper. During farmer agitation, procurement by FCI was there in the newspaper. So please be very careful. It is involved in the implementation of PDS along with its commercial operations. It is involved, that is Food Corporation of India. By the way, remember this, FCI is a statutory authority. We have passed an FCI Act, Food Corporation of India Act of 1964, and from 1965, Food Corporation of India actually became operational. It became operational in India. And from when did we implement MSP? MSP was implemented in India from 66, 67, starting with wheat. All these are certain factual informations. Please remember this. Now look at the statement here. It is involved in the implementation of PDS along with its commercial operations. Statement is wrong. Why? FCI does not have any commercial operations. FCI, Food Corporation of India, does not have any commercial operation. The role of FCI right now is procure the food grains as per the directions of the government of India and distribute the food grains under public distribution system. That's it. That is the role of FCI. It doesn't have any commercial operations. First statement wrong. Second, location and number of purchase centers to be opened are decided in consultation with or by the state government. This statement is correct. Understand this. We say that Food Corporation of India will procure food grain from the farmers. That is a basic idea. FCI pays MSP and procures food grain from the farmers. But where will they be present? Will they go to the farms, purchase the food grains? Or when the farmers are taking the food grain to the market, midway the FCI will come, stop them and purchase the food grain? How the procurement is actually done? Procurement centers or purchasing centers are opened in mandis. I will repeat it. Procurement centers or purchasing centers are opened in mandis. APMC, I hope you have read this. Agriculture Produce Marketing Committee, and under APMC will set up mandi system. So within the mandis, FCI would open procurement centers or purchasing centers. But how many to be opened? Where to open? Generally, they will hold a consultation with the state government and then the decisions are taken. So the statement 2 is correct. First one is wrong. Right option for this particular question will be only 2, that is option B. Okay, option B is the right one. Let me go to the next question. Which of the following statements or statement is or are true? First one, states announcing the SAP. SAP, by the way, stands for State Advisory Price. SAP stands for State Advisory Prices. State Advisory Prices. Right, that is SAP. And second one is FRP there, Fair and Remunerative Prices. Fair and Remunerative Prices. Done? So one is SAP, second one is FRP. SAP is announced by the state government. Remember this. SAP is announced by the state government. FRP is announced by the central government, specifically Cabinet Committee on Economic Affairs. Cabinet Committee on Economic Affairs, CCEA. But please understand this, whether it is SAP or FRP, both of them are connected to sugar cane. Both of them are connected to sugar cane. It is not connected to any other crop. It is connected to sugar cane. Unlike, understand the difference here. Right? Don't say, sir, just like bonus and MSP then. No, different. Both are different. Both the sets of terminologies are different. Do not be confused. What is this? MSP is announced by Cabinet Committee on Economic Affairs. Done. Announced by Cabinet Committee on Economic Affairs. What about FRP? Announced by Cabinet Committee on Economic Affairs. What about SAP? State Advisory Prices. State government. What about the bonus? Announced by state government. Sir, one and the same. See, SAP, state government. Bonus, state government. One and the same. You are wrong. No, both are different. Why? In case of the FRP and SAP, these are connected to sugar cane. And remember this, government doesn't procure sugar cane. Government, either the central government or state government, they do not procure sugar cane. Remember this. Whatever is the sugar cane produced by the farmer, they will have to sell it to the mill owner. They will have to sell it to the mill owner. Government doesn't procure sugar cane. Whereas in case of MSP and bonus, for let's say paddy, or that is rice, for wheat, for other products or other agriculture commodities, government may procure them. Government will actually procure these particular food grains. Right? For example, rice and wheat, they will procure it. Pulses, they will procure it. Right? Coarse grains, they will procure it. So remember the difference here, right? Very, very important. Remember the difference. In case of FRP and SAP related to sugarcane, government doesn't procure sugarcane. But what is this idea of FRP and SAP? FRP is announced based on the recommendations of Commission for Agriculture Cost and Prices. CSEP will give recommendation to Cabinet Committee on Economic Affairs, and it is the CCEA which will decide the FRP. But please understand the very important point here. Apart from this, state government also announces SAP. For example, states such as Haryana, Uttar Pradesh, Tamil Nadu, right? They announce the SAP, State Advisory Prices. Please look at the difference here. SAP could be higher than FRP. SAP could be higher. In fact, it is higher. And when in states, the SAP is higher than FRP, the mill owner, when they will purchase the sugar cane, they will have to pay SAP for this. I will repeat it again. In case of FRP announced by the CCA, SAP announced by the state government, if the SAP is higher than FRP, which is generally the case, the sugar mill owner, when they will purchase, right, the sugar cane, they will have to pay SAP, not FRP. Whereas in case of MSP and bonus, it is slightly different. Imagine the state government has announced a bonus of 200 rupee and the MSP is 1000 rupees. If I am the farmer, I will sell the crop to the government, I will get the MSP plus I will get the bonus also. Slightly different concepts, so please be very, very careful. Now, some of you will be thinking, sir, why does government do this? Right? Why does government of India suppress so much the mill owners? There is a particular reason. There is a very important reason. Reason is very simple. If you have cultivated sugar cane, you will have to crush the sugar cane within certain number of days. You cannot keep it, store it for 1 year, then start crushing. After a couple of days, sugar cane quality will be lost. So the sugarcane cultivators, that is the farmers, will not be able to negotiate with the mill owners. And the mill owners can simply leverage the position and say that if you sell it only at this price, I will purchase it. Otherwise, I will not purchase it. So don't you think the sugarcane cultivators, that is the farmers, will be at the mercy of the mill owners? So government says, no, I will not allow this to happen. Government shall decide at what prices the mill owners will purchase the sugarcane, that is SAP as well as FRP. Done? Look at the statements now. States announcing the SAP for sugarcane pay and procure sugarcane at this and not at FRP. But please be very careful, I am saying states announce, states procure. Does the state government procure the sugarcane? Absolutely wrong. Central government announces FRP for sugarcane and procures it. Does the central government procure sugarcane? Does the central government procure sugarcane? Absolutely no. That is also wrong. Both the statements are wrong. Right option will be option D, neither one nor two. Neither one nor two is the right option here. Next question. Which of the following statement or statements regarding one nation, one ration card is or are correct? Regarding ONORC, it is correct. Let's start. It is implemented by the Ministry of Agriculture. Looking at one nation, one ration card, right? Food grains are distributed. You'll be tempted to say yes, statement 1 is correct. No, this is wrong. Statement 1 is wrong. Right? Which is the authority which will implement it? Right? It is the Ministry of Consumer Affairs. It is the Ministry of Consumer Affairs which will actually implement it. Right? Within the Ministry of Consumer Affairs, it is the Department of Food and Public Distribution. It is the Department of Food and Public Distribution which is the nodal authority for implementation of one nation, one ration card. First statement wrong. The beneficiaries under ONORC will be identified through Aadhaar. Right? The beneficiaries of NFSA are there. There are beneficiaries under public distribution system. How they will be identified? That is a statement here. The beneficiaries are going to be identified using Aadhaar itself. Right? For example, have a look at this. For example, imagine I am one of the beneficiaries under the PDS. There is a ration shop. Under ONORC, I will go to the ration shop. I will provide my thumbprint. I will simply provide my fingerprint like this. and when I provide my fingerprint, the machine will read my fingerprint and just get the data that yes, I am one of the beneficiaries under public distribution system. And the shopkeeper here now realizes that I am a beneficiary and will provide the entitlement, that is a 5 kg of food grain to me. So under the One Nation One Ration card, the beneficiaries will be identified using Aadhaar system. Yes, statement 2 is correct. Third, Anna Vitran portal maintains a record of interstate transaction, and the IMPDS basically stands for Integrated Management of Public Distribution System. I repeat, IMPDS stands for Integrated Management of Public Distribution System. IMPDS portal records intrastate transaction. Statement is wrong. Why? Look at this very carefully. There are two pillars. The whole idea of ONORC functions on two systems or two pillars. What are these particular two systems or two pillars? One is Anna Vitran portal. One is Anna Vitran portal, right? Anna Vitran portal, which will basically consist of all the transactions which are intrastate, which will consist of transactions of intrastate. That is, a beneficiary, whenever he will get the benefits within the same district or a different district but within the same state, that is called as, those transactions are recorded in the Anna Vitran portal, and those transactions are referred to as intrastate transaction. What about the other situation? A beneficiary has moved from state 1 to state 2, and he will get the entitlement in the state 2, food grains in the second state. Those transactions will be recorded, right, in the IMPDS, Integrated Management of Public Distribution System. So interstate here and intrastate here, and the statement is exactly vice versa, opposite. So third statement is wrong. Second one is correct. Right option for this particular question will be only 2, that is option A. Only 2 is correct. Done. Let me go to the next question here. Which of the following are covered under MSP policy of the government? In simple terms, on which of these particular crops MSP is announced by the government? Again, when I say government here, you can simply read this as Cabinet Committee on Economic Affairs, because technically speaking, it is the Cabinet Committee on Economic Affairs which announces MSP, which decides MSP. Right now, what is the MSP? MSP is 150% of cost of production. 150% of cost of production. MSP is 150% of COP. And the MSP, the recommendation of MSP is given by Cabinet Committee on Economic, the Commission for Agriculture Cost and Prices to Cabinet Committee on Economic Affairs. Recommendation is given, and it is the CCA which will decide MSP. Right now, the website of CACP says we will announce MSP or we will recommend MSP for 23 crops, including sugarcane. We will recommend MSP for 23 commodities, and within this particular list of the commodities, there are oilseeds, 7 oilseeds are there. There are cereals, 7 cereals are there. There are 4 commercial crops, and there are 5 pulses. Total 23. 7 plus 7 plus 5 plus 4. Total 23 crops, including sugarcane. So for 23 crops, I will consider certain parameters. For example, what is the supply and demand of this particular crop in India in the global market? What is expected price of this particular commodity in the domestic market? What is intercrop price parity, right, etc. What are the factors of inputs, right, and 50% extra amount has to be given to the farmer. So basic parameters or basic features will be considered, and MSP recommendation will be provided, and the government will decide MSP like this. MSP is equal to 150% of COP. And one more very important point here, MSP is not legal in India, or there is no legal backing for MSP. Remember this. There is no legal backing for MSP. What do you mean by legal backing? Legal backing here, there is no law regarding MSP in India. It is the executive authority of the government. There is no legal, right, or there is no legal backing, or there is no act which mentions MSP in India. And this was one of the demands of the farmers in recent times. They wanted a legal backing for MSP. Right now, is it there? Absolutely no. And earlier itself I've told you, initially we started the concept of MSP back in their 66, 67 with wheat, and over a period of time we have covered more and more crops under the concept of MSP. Done? So these are certain very important aspects. Please be very, very careful. Now one more very important point here. What is this cost of the production? You must have read in the newspaper the cost of production that is used by the government to decide MSP is A2 plus FL. A2 plus FL. In fact, understand this, CSEP will consider 9 types of cost of production. I repeat, CSEP will consider 9 types of cost of production. There is A1, A2, A2 plus FL, B1, B2, C1, C2, C3, C2 star or C2 dash. 9 types of cost of productions are there. Don't mug up all of them. For UPSC, this is more than sufficient. And more than sufficient for UPSC. Now look at the question here. Which of the following are covered under MSP policy of the government? That is the policy of the CCA. Copra, yes. Sugarcane, yes. Cotton, yes. Raw jute, yes. Now some of you will basically fight with me over the sugarcane. You will say that, sir, it is FRP, not MSP. But if you just look at the CSEP website, it simply says, yeah, I will announce MSP for all the crops including sugarcane. But specifically for sugarcane, methodology is slightly different. Hence the term FRP is actually used there. So 1, 2, 3 and 4. Right option will be option D here. Right? It is at the bottom. Option D is the right option for this particular question. Done? Right, so these are the various questions that I wanted to discuss with you people for the third lecture on Indian economy under the Target Prelims 2022. If you like this initiative, please hit the like button. Provide your valuable comments in the section below. And if you have not yet subscribed, please do subscribe to BYJU'S Exam Prep IAS. See you tomorrow again with the fourth lecture on the Indian economy. Till then, bye. Take care.